Can Fin Homes Q4FY23 earnings conference call hosted by Investec Capital Services. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nidesh Jain from Investec Capital Services. Thank you, and over to you, sir.
Thank you, Aman. Good afternoon, everyone. Welcome to the Q4 FY23 earnings call of Can Fin Homes Limited. To discuss the financial performance of Can Fin Homes and to address your queries, we have with us Mr. Suresh Iyer, MD and CEO, Mr. Amitabh Chatterjee, Deputy MD, Mr. Apurv Agarwal, CFO, Ms. Samila, Business Head of Can Fin Homes Limited. I would now like to hand over the call to Mr. Iyer for his opening comments. Over to you, sir.
Yeah, good afternoon, and thank you, Nidesh, and thank you everyone for joining this call on the Q4 results of Can Fin. Just to give a brief highlights of the fourth Q4 performance and the results that were declared yesterday. So the company had a good disbursement growth of 8% in terms of for the entire year, and the portfolio growth of 18%. The net NPA the NPA has come down from 0.64% to 0.55% gross, and the net NPA has also come down to 0.26. So on the collections and recovery front, the performance has been good. We have been able to bring down the NPA. The provisions we have had taken a conservative view, and therefore the provision coverage ratio has also improved over the last year, which I believe would give a good comfort to all the people. On the NIM front and the spread front, as you all know, the rates have been going up, and therefore in the earlier quarters we've had on the liability side, the entire interest going up because of the impact of the increase in rates. Whereas on the asset side, we had the gradual increase which was happening because of the reset at different points in time. And the entire impact of this rate hike on the asset side has not yet experienced in the books. And in the coming 2 quarters also, we expect the impact of this rate hike because of the interest reset tenures. And therefore, the interest spread will slightly start improving going forward, which you would have seen has already happened in the Q4 as well, because a sizable chunk of about 10,000 crores has witnessed the impact of a rate hike in this quarter. So that's about it in terms of the performance. The cost to income ratio is also down from 18.32 to 16.93, and I leave it to all of you for eyes open for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Devansh Negotia from SIMPL. Please go ahead.
Yeah, so thanks for the opportunity. Sir, in our asset liability statement, you mentioned for the April to June bucket, there was a mismatch of, I think, 3,500 crores. Can you just elaborate on that?
Sorry, can you please repeat? The voice was a bit on the lower side.
Yeah, can you hear me?
Yeah, it's better.
Yeah, so the asset liabilities statement that we share every 3 months, 6 months, or there for April to June quarter, there is a 3,500 crore mismatch. So just wanted to gain clarity on that.
Yeah, so we are carrying sanctioned undisbursed limits from the banks, which takes care of a short-term liquidity management.
And how much is the limit?
The undrawn limit is roughly around 4,600 right now.
So basically, the April to June bucket mismatch will be taken care of with these undrawn lines with the banks.
Yes.
And we were looking to raise capital, so any updates on that? Are we still evaluating, or any thought process if we can share?
No, if the need arises, we will also. As of now, there is no immediate step for the raising of capital. As and when the need arises, we will be looking at it.
Okay. So 8 times leverage is what you're comfortable with?
Yeah, about 8 times. I think even even with the rating agencies, I feel there is no issue with the gearing of about 8. In fact, the gearing has slightly come down in the last 1 year. Now it's below 8 actually.
And in our salary, the customer mix, we share that 50% is government salary. So what prevents them for taking a BT towards banks, because they can save 1.5% over there? So what prevents them from going to the banks? If you can just share, is there an entry barrier which, if at all there is any, or is it something else?
No, there is as such. If you can see, the fact that they have come to us is also because of the service and the dedicated team, because we have a single product company, so obviously the 100% focus is on giving customer service. Second thing is, instead of we have a network where the branch managers themselves are directly dealing with the customer, so there's an association of the customer with our staff as well. And for up to 1% and all, the actual impact on the EMI on an ongoing basis is not much. So the kind of service that we are getting and comfort of coming to us and having a loan sanction in a quick time and the local service that is available is what for that they are ready to pay a little bit of a premium, which converted into EMI terms doesn't become much. So if you can see, the prepayment rates are not at all worrying. In fact, it's been quite on the steady state. There's no such worry on the prepayment rates either.
Okay. And so just on undrawn limits, what is the interest rate on that?
Sorry?
With the banks? The undrawn limits that we have with the banks, what is the interest rate that we pay on that?
So these are basically linked to certain benchmarks that would be decided at the time that we draw them. So basically, it would be decided on the time of disbursement drawdown.
So there is no, in case you are asking as to whether we have to pay any charges for holding on to these undisbursed portions, no, there are no such charges. It's only a sanction limit which will start where the meter will start once we draw the funds.
I'm confused that if there will be repayments which will be, the repayments that will happen will be more than the disbursements will be more in this April to June bucket for 3.5. So we are fulfilling with the banks, but there is some interest that will be paying on that. So that is what my question is.
Okay. I'll just explain. So we have a monthly collection which is approximately a little around 500 to 550 crores. So in the one quarter itself, we'll be collecting in terms of the EMI and in terms of whatever collections that come from the customers is the trend that we have observed, including the prepayments, comes to around 500 crores a month, which is 1,500 crores in the quarter. That plus, if you look at the undrawn limits that we are having, so we are quite comfortable in terms of the liability or the thing which is coming due for payment.
And one more thing that we are not taking into account in that SLA statement, that is as per norms, so we should not take the available CP limit, which is available to us, that anytime we can draw from market and to meet our funds. That is not used for as per guidelines. It is not used for taking as a inflow of funds for the computation of SLA statement.
Correct.
Okay. Thanks a lot. I'll come back to it.
Thank you. The next question is from the line of Gaurav Kochar from Mirae Assets. Please go ahead.
Yeah, hi. Thanks for taking my question. Good afternoon, gentlemen, and congrats on the quarter. Sir, you've made a standard asset provisioning of 25 crore in this quarter. Can you explain the reason for creating this? Is this for strengthening the restructured provisions or in general some strengthening of stage 2 provisions?
So it's not actually for any thing. It's just that, as I mentioned in the beginning itself, that we are just strengthening and taking a conservative view and strengthening it for the improvement in the provision coverage ratio. And it's in the ECL model, whatever is there, that we have taken. Plus, so beyond that, there is a slight additional that is being carried for just to improve on a conservative basis the PPCR.
Okay. So what would be the total quantum of provisions that we are carrying on balance sheet as on 31st March?
312.
And what was it last quarter, if that number is handy?
Yeah, 290.
290. All right. And this would be across buckets, stage 1, 2, and 3, depending on the methodology. Understood. Thanks for that. The second question is with respect to the yield, the jump in the yield. That 8.87 went to 9.87 during the quarter. And earlier in the call, you mentioned that there is some bit of repricing which is still pending and which will happen over the next couple of quarters. So just wanted to understand in this context, and also the cost of funding inching up to 7.5, where should ideally the NIM settle in FY24? This quarter it was at 3.37. So incrementally, given that spread has improved and spread will continue to improve, can we expect this to move towards 3.5, 3.6 mark over the next few quarters?
Yeah. So just to explain, in the last quarter, out of the entire book of about 30,000 crore, we had about approximately close to some 10,000 crore which came for a reset, and where the interest rate was hiked as at the time of the reset. That has what has helped us in improving the NIM and the yield on the book. Additional to that, in fact, the rate impact on the new customers also, we have been charging at the higher rate post the rate hike. So the new customers have all been coming at a higher rate. So both these factors have resulted in the yield improving from 8 point something to 9.88 plus. That is point number one. In terms of the second part of your question as to what is the quantum of the portfolio which is yet to experience a rate hike, we still have about 18,000 crore which is yet to receive part or full of the rate hike that has to be passed on. This will come over the next two quarters, that is in the April to June quarter. Another 5,500 crore of book is likely to come up for a little bit of price of rate hike. And in the quarter subsequent to that, that is in the July to September quarter, another about 7,500 crore plus is likely to come for a reset. So both these things will help us in further improving the yield. And right now it's about 3.45. So yes, we can expect around 3.5 or thereabouts, or a little better also probably going forward.
Sure.
And on the same line, the other side, you said about the rate of the cost of 7.51. So almost the entire liability side, we have already experienced the rate hike on the liability side. So from going forward, unless there is some negative impact or something, the rate is remaining stable as they are as of the moment. Further increase on the cost side is not very likely.
All right. So the yield repricing would continue in the next 2 quarters, whereas on the cost side, large part of it is already behind us. Is that a fair sort of statement?
That's is not a fair part. Yeah, almost 50% of the rate hike on the asset side has been passed on. Another 50% likely to come up. So around 3.5% kind of a NIM is something, yeah, we can look at, which is 3.45. A few 5 to 7 bits improvement in the NIM can be expected.
Sure. So mathematically, that number looks higher because if, let's say, half of your book is going to be repriced, let's say even by 100 basis point, that would take the yields up by 50 to 75 basis points. And at the same time, on the cost side, if it is largely done, or maybe another 10, 15 basis point comes up, then you're talking about 30 basis point of incremental margins over and above the 337 you reported. So mathematically, this looks like a 360, 370 kind of a number. But you're saying it will be more or less in the range of 3.5.
Yeah, so it's not an entire 100 bits kind of an increase that we are looking at. So there are some because last year we increased our rates on 3 occasions. So part of the portfolio has already experienced the full 3 cycles completely, or the 3 rate hikes has been passed on. In some 2 rate revisions are yet to be passed on, and in some only 1 is yet to be passed on. So that way, on the entire remaining 50%, the entire 1% plus is not likely to pass on. There is going to be 2 parts. Some of it will experience about 85 bits, the others will experience about 35 bits.
Got it.
That's the kind of breakup, yeah.
Sure. Perfect. And just lastly, on AUM growth, whilst overall AUM growth remained healthy at 18%, the disbursement was slightly soft, about 25 odd billion. So going forward, now that you've taken over next year, what would be the disbursement target? Maybe let's say overall yearly disbursement target, and in that context, what kind of AUM growth are we looking at from a medium term, maybe 2-3 years?
As I again explained in the beginning, that the rate hike that has happened. I would like to say the rate hike that has happened has slightly impacted the demand, as you would also have seen from the commentaries from other rating agencies as well as some banks. These rate hikes have impacted the EMI, and therefore there is a rethink by some customers and resulting in slight impact on the demand. Even ICRA, for that matter, had predicted about 13% kind of a growth and on all. Having said that, now with the rates being stable, we can look at some improvement in the demand, and some supply side also, post the CLSS getting over, there was a slight shortage or reduction in the supply, which also should come back in the market. So once that happens in the coming year, probably in the second half, definitely we can expect the demand to be really picking up. So on a portfolio basis, we are confident that about 18 to 20% kind of a growth in the loan book should be possible.
Okay, sure. Great, sir. And just a related question to this, if I look at our average ticket size is around 25 lakhs, maybe at Graha the ticket sizes were slightly lower, maybe more affordable sort of a segment in Graha Finance. Is there a possibility of maybe the share of the lower ticket loans incrementally increasing, or maybe moving towards the 10-15 lakh category, or the share of 10-15 lakh category increasing over the next 2-3 years? Is there a possibility of that?
As of the moment, if you look at the branch network, there's a difference in the branch network that Guru was having and the branch network that here at Canfin is there. Today here we are having a maximum presence in the metro and urban towns, and the business is coming from the towns as well as from the periphery areas, whereas Guru had a very large portion of branches which are in the deeper pockets. So obviously the deeper pockets, the property costs themselves are a little on the lower side, whereas here if you look at the urban towns and the metros, the property cost therefore itself is on the higher side. Like you won't get a property even in the periphery of a Bangalore or a Pune or places like that at a cost of less than 35-40 lakhs. Okay, right. So that being the difference, if that mix has to change, then there has to be a much a deeper penetration will have to come, which will be from branch expansion. Also, that can't happen very quickly or overnight. So as of the moment, the focus will remain in this sweet spot, which is around 20 to 25 lakhs.
Sure. Perfect. Great, sir. Thanks a lot and all the best.
Thank you.
Thank you. The next question is from the line of Ankush Agrawal from Surge Capital. Please go ahead.
Hi, sir. Thank you for taking my question. Firstly, sir, now that you have joined Canfin, so I wanted to know what would be your key priorities and focus areas for next coming years, like in terms of, say, branch expansion or adding new product portfolios, or, in terms of what kind of construct do you look at Canfin in terms of spread, names, ROA, and leverage, if you can highlight that.
Okay, so in terms of the first part of the question regards expansion, yes, in the last 3 years, because of this COVID and all, there was a pause in terms of the branch expansion, which we would be looking at. In terms of the presence, geographically, we are having a very widespread presence across the country. So within those existing areas of operation, definitely there are opportunities in large upcoming towns and big cities where we can look at. So we will be looking at it, but it will be on a gradual basis where we will be looking about 10 to 15 branches a year. That will be something as on a very manageable basis that we can look at, and that's what we'll be looking at. In terms of the business mix, yes, there's a very healthy mix as of the moment of 70% of salaried and incrementally also, and SENPF about 30%. It's a very comfortable mix as of the moment, which we would like to continue. And the focus will continue to be on growing the business from the retail segment.
Okay. And in terms of kind of ROA and leverage that you target?
So the ROA is right now inching up and it's already 2.17. So ROA, And so I think that's a very comfortable kind of a ROA that we are looking at. The ROA is also, now about
16, 17.
Yeah, 17. It's just for 17. So I think, in terms of this, it's a very healthy ROA.
Yes. Okay. And again, touching on the disbursement side, so you mentioned that for FY24, you're confident on 18 to 20% growth on the book. But in terms of disbursement, how do you look at it?
I'm sorry, I didn't get your question. From the disbursement side, as in?
Like for the loan book, you have guided that you're confident on 18 to 20% growth for FY24. Right? But in terms of disbursement, do you believe that there will be a healthy disbursement growth to accompany this loan book growth?
Yeah. So about a 20% growth in the loan book will be able to help us achieve or maintain this 20% loan book growth as well.
No, but at the 20% disbursement growth, I believe the loan book growth will be much higher, right?
No, it won't be very high because you also have to look at the prepayments and the amortization that happens. So if you look at a 20% growth going forward, you are talking about somewhere in the range of about 10,000 something crores, 10,500 odd kind of crores. And from that, if you look at the prepayments and all, there would be prepayments and amortization happening. So net about 6 to 7,000 crores is the growth that will happen in the book, which will be about 20%.
Okay. Thank you. That's all.
Thank you. Next question is from the line of Dhaval from DSP. Please go ahead.
Yeah. Hi, Suresh. So just on the distribution side, so you highlighted that about 10 to 15 branches that you're looking to add. Just from a medium-term perspective, I think currently the business is largely sourced from the DSA network. How do you see the sourcing mix and the branch expansion journey? I mean, would it change, or by and large you'll just move in the current template? Any thoughts around sourcing and distribution network?
Yeah. So in terms of the present the DSA channel is a very strong source for us, for our sourcing channel for us, and that will continue. But yes, there is a lot of opportunities in tapping the existing customer base and getting business from our existing walk-in customers and doing some digital marketing as well. So we'll be exploring that. So that probably could slightly increase the composition from the direct business also. But the DSA business will continue to constitute a sizable portion of our sourcing.
Understood. And in terms of geographic concentration, I mean, historically, Karnataka, Tamil Nadu used to be a big part over a period of time. While they're still significant today, the share has been coming down over the last few years. I mean, just if you take a 3-year view, how do you think about geographic concentration and within that, sort of opportunities in tier 2, tier 3? I mean, any thoughts around that would be useful.
Yeah. So our present composition of the book is that about close to 65% plus of the book is coming from the southern states, and the remaining from the other rest of the country. So yes, going forward, obviously, though the base is lower, the growth can still be on the higher side. But in terms of that, this can inch up somewhere in the range of about 60-40.
Okay, got it. And just last couple of things in terms of gaps. Any gaps that you see either on the technology side or any other HR side, or anything around any gaps that you believe that needs to be filled in the next 3, 6, 9 month period? Any thoughts around that?
As such, there is no major something to be worried about actually. The normal things that would obviously be there. I don't see any kind of a challenge in that sense. That the team is quite stable, it's well experienced. The processes are very much in place. The audit and the audit pillars are very much in place. Compliance and regulation. So there are all these aspects when you look at it. It's a very kind of robust machine which is already in place. So nothing which I would say is an area of concern.
Got it. And last question is on the hiring of the CRO and the CFO. Where are we in that?
CFO is already on board.
Hello.
Okay.
I'm there.
Okay.
He's on the call with us, yeah.
Okay, great. And CRO?
We do have a gentleman who is presently looking at it, but yeah, we will be looking at somebody going forward because we still have people retiring and senior people on board who will be so we'll be looking at something.
Great. Wish you all the very best. Thank you.
Thank you so much.
Thank you. The next question is on the line of Manoj Oberoi from Yes Securities. Please go ahead.
Yeah, sir. Hi. Good afternoon. This is Rajiv here. Thanks for taking my question. Sir, the first question is on the BT out quantum in this quarter. What was it and what was it in the last quarter? And also, if you can tell us what was the movement in stage 2 assets on sequential basis.
So the BT out per quarter is roughly in the range of 100 crores.
In a quarter?
Yeah, in a quarter, full quarter.
And Apurav, same number last quarter will be?
Broadly, yes.
We've not actually seen any change in terms of the BT, the pressure coming for balance transfer. Whatever is the regular course of business that is happening, that is what we've been experiencing.
Correct. But what I see is that the absolute portfolio rundown in the quarter is lower than the preceding quarter. What would explain that, sir?
So we also had a CLSS claim that was received in this quarter about 30 some. So total about 262 crore is the 272 crore is the CLSS that also was there during the year. So that is also one of the reasons why this is on the higher side. And as you know, the CLSS credit that is received has to straight go to the principal.
Yeah. Sure. Sir, on cost of funds, you're expecting that the cost of funds may not increase significantly from here on. But I was looking at your marginal cost of funds for the quarter. It is 7.5, and your stock cost of funds is 6.3. So if the marginal rate is so higher than the existing overall rate, then it has to go up materially.
Yeah. So as I said, so on the yield also now we've seen about 8.99, and going forward we have these two tranches of about totaling up to close about 18,000 crore, which is due for reset in the coming 2 quarters. Plus the incremental business is also happening with an average yield of about 9.8% plus. So that way, if you look at the math, it will continue to the spread will continue to be maintained at the present rate of 2.65.
Okay. Just last question. Sure. Please continue.
One more thing. This quarter we have raised NCD to the tune of 1,000 crores at a rate of 8.45 as a mandatory requirement. So I think that has led to a slight increase in marginal cost of funds.
Okay. Got it. And sir, what are your thoughts on tapping the assessed income segment? So while you spoke about the ticket size remaining where it is, the composition of salaried and self-employed remaining where it is, but from a customer profile perspective, informal income, are we thinking on those lines, or would we be thinking on those lines sometime in the future?
As of now, we are comfortable with the present 70-30 kind of a mix. And right now, we look at it as we go forward. But as of the moment, we are quite comfortable with the 70-30 mix.
Sure. My one question on stage 2 assets, I was requiring those details. Yeah.
Yes. So stage 2 assets have not moved much, but the concern that you had earlier with 25 additional has been moving into standard. That has been partly explained by Yasir in the previous discussion just now. That basically just after the profit, certain buffer has been created. That's it.
Okay. Thank you. Best of luck.
Thank you. The next question is from the line of Onkar Gugadre from Shree Investments. Please go ahead. Onkar, your line is unmuted. Please unmute yourself and proceed with your question.
Yeah, just wanted to know, at the beginning of the presentation, you have stated that the journey has just started, 35 years and counting, and it's just the beginning. I mean, why do you say like that? Just wanted to know.
It's a very big market, and we are still a small player, so there is a huge scope for growth, and there's a very long runway. So basically, that's what we look at it. That's why we're very positive about this.
Yeah, but in terms of the growth rates, if you talk about that, then you have been, I mean, it has been average, right? I mean, other players are growing at much faster rate and with kind of similar NPAs.
What I'm trying to say is that it's not from the point of view of a growth or an immediate growth or in that kind of a spurt in growth or anything, but from the point of view that at 35 years also we are young, because we still have a long way to build the organization, and two, that we also have a long runway in terms of the housing market in India. So from that potential, we have from a 31,000 crores to about a lakh of crores, still something which is very much in the not so far away dream for us.
Yeah, but as far as the addressable market is concerned, it is for each and every player in the housing, right?
That's
housing finance company.
We also are very positive about, so that we just share. I mean, others also share the same view. That's about it. Yeah.
And earlier you used to give certain targets for like next year or for 2 years. So I've stopped giving that. Any particular reason for that?
We just shared. So I think there was an earlier question as to what is the loan book growth. So we did mention about the loan book growth in the range of 18 to 20%. That's what we just.
Correct, but earlier there was some stated, it was given in your presentation. You have just removed that. I was asking about that.
No, I mean, there's nothing of that sort but I think this has been the standard thing we've been talking about. 18 to 20 is kind of what we have been saying for the last few years, and we continue to have the same.
Maybe earlier presentation it may have been there. But this presentation, I think it is not there.
Yeah. So I was talking about that one.
The story will remain the same. 18 to 20, we are quite comfortable. It's a healthy growth rate. At the same time, it is a very manageable growth rate. So that's what we will look at.
Okay. And as far as the debt to equity, you are saying 8 times leverage is comfortable. You are comfortable with. I mean, you just said it is 7.97%. I mean, you said that whenever it is required. I mean, is there any particular level in your mind that at this rate, at this point, we will do it? At certain gearing, we will do it.
See, as of the moment, looking at the growth trend, if you look at it, the internal accruals and the healthy profit ratio that we are having, the internal accruals should also be able to give us a good amount of growth scope for growth. Plus, if you look at the requirement or the regulatory limit, it's 12 times of the net worth you can borrow. So there is still a good runway that we are having.
Correct, but you haven't gone beyond this like for many years now, right?
I think, sir, if you look at the maybe 2018-19, that time our debt equity was more. It was close to 9 and 10. So from that, it has now been reduced to 8. So 8 is comfortable for us, and our bankers are quite comfortable at giving at a cheaper rate at this leverage ratio.
So in the near term, there is nothing in the offing, you are saying, right?
See, we have got an enabling clause in AGM about raising of capital. If we find that growth opportunities are there, good growth opportunities are there, then we may review our position. And if required, there is always an enabling clause, we can raise a capital.
Okay, as far as the current situation is concerned, how is the situation you are?
I think maybe in the coming 2 to 3 quarters, we do not feel any need as such.
And with the profits which are being plowed back, we should be able to take through for the year also.
Okay, just one question on the demand side. Any pressure you are seeing on the housing demand side?
As we said in the beginning, yes, because of the rates, there was a little bit of a slowdown, which we expect will, change as the rates have now remaining flat and will hopefully start going down also. So that should also push the demand.
Okay, and as a
personal opinion on the rates fronts going, say, next 2-3 years, how much reduction do you see? Just a personal opinion. Your personal opinion on the rate cut which you would be expecting, say, next 2-3 years. Not your your opinion, not the company's opinion.
I mean, I can talk about wishful thinking, but I guess a qualified opinion can only be given by the RBI, and the person will only determine that. Otherwise, it can only be wishful thinking.
Correct. Okay. All right. Thank you.
Yeah.
Thank you. The next question is from the line of Pooja Ahuja from Monarch Networks. Please go ahead.
Yeah, hi. Thanks for the opportunity. So since you've mentioned in this quarter, we've taken higher standard asset provisioning and increased the PCR. So for the next 2-3 years, could you guide in terms of credit cost? What sort of numbers are we building in?
No, it's not because of that we are expecting any higher credit cost that we have, made this provision. As we said that we are quite comfortable with the collections and the recovery position is quite comfortable. But it's just that, just with the thing of being on the conservative side and to improve the PCR ratio, we have actually had this additional provision. Otherwise, we are quite comfortable. So we don't expect to see any spike or any increase in the credit cost going forward also.
So is a 10 to 15 bips kind of a sustainable level for our kind of model?
Sorry?
10 to 15 bips, is that a sustainable level of credit cost we can expect?
No, incremental credit cost is
not 10 bips. That is
I think credit cost should hover around maybe 5 bips or maybe plus 7 bips, maximum 7 bips.
That's what.
Okay, thank you for that. And secondly, on the borrowing mix, we've seen that the CP share has gone down. Just wanted your perspective on how do we see this mix going forward?
So CP is used as a cost leverage tool, and as you experience that the capital markets are not so favorable in the closing quarters of the year. So we analyze whatever is the best possible solution, be it from the bank side or from the capital market. Accordingly, we choose the source of funding.
Okay, all right. Yeah, that's it from mine. Thank you.
Thank you. The next question is from the line of Jigar Jani from B&K Securities. Please go ahead.
Yeah, hi. Thanks for taking my question. A couple of questions. So I'm just looking at your slide on slide number 12. We have seen an increase in spread on a sequential basis, but our NIMs have compressed on a sequential basis. So any one-offs there in the NIM figure?
What was the last part of it? Is there any?
Any one-offs? Because we have seen net interest margin, your reported net interest margin dropped from 3.47 to 3.37, despite spreads increasing by 2.24 to 2.36.
Yeah, so there is just a timing difference in this quarter, but on the longer term basis, if you look at the coming quarters, there will be likely improvement or in the spread and NIMs. Because as I explained earlier, we are expecting the on the asset side, the rates to be slightly adjusted as the impact of the reset happens.
Okay. And sir, can you just guide with the, so when you say 7.51 is the cost in this slide, that is the cost for the entire quarter, or is it the exit cost that you are giving us? Because there is another slide on slide 16 where you are giving the quarter 4 cost to be slightly lower. So just wanted to reconcile which is the quarterly cost figure.
Yes. So what happens is, in this slide, we give the incremental cost of borrowing for the specific quarter, and in the next slide, we give the total cost of funds for that quarter.
Okay, understood. And right now, what would be the incremental cost of borrowing? Could be similar?
It would be on the lower side than the last quarter, because last quarter we had to raise the NCD as per the regulations of the SEBI, which was on the higher side, and the composition of the NCD was also on the higher side to comply with the regulations. This quarter, incremental cost of borrowing should be lesser than the last quarter.
Okay. Maybe any figure you could guide to, or 10, 20, 50 bits, how much would it be lower?
It is difficult because right now...
Okay, understood. No worries.
I think it is generally first quarter, the disbursement generally doesn't happen as it happened in fourth quarter. So it depends on what will be our requirement of funds. At that point of time, we'll see what will be our incremental cost of borrowing for this quarter. Maybe if CP is prevailing at low rate and we will come down, and after our ALM supports raising of CP, we may raise CP also. That will be at much lower rate than the bank borrowing.
Understood. And sir, what was the outstanding restructured book, and has some part of the restructured book started paying, and how has been the performance there in terms of collection efficiency and numbers, basically bounce rates, if you could guide something?
Yeah. So the total restructured book is around 695 crores. It has just, in fact, effective February, started coming out of it. So it's actually too early to give a prediction or a kind of a listing as to how it will behave. So efforts we have already initiated, and the customers are also, will come back and start paying. So that's the kind of thing. It's not a very large book that is there, and we expect that the repayments also will start. So I guess the next quarter will be a better time to really give you a picture. I will be in a position to give you a picture as to what is the trend of the repayments.
Sure. And sir, last question is on the cost to income ratio, any guidance? Will it hover around the 16-17% level?
We are already at a tag below 17%, and we can expect it in the same range of about 16 to 17% kind of a range that it will operate.
Okay. Thank you so much, sir, for answering my questions, and best of luck.
Thank you. The next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yes. Thank you for taking my questions. Firstly, I just wanted to understand, has there been some change in the way we classify bank borrowings and NHB borrowings? The reason I ask is, if I look at the funding mix or the borrowing mix that we give, please correct me if I'm wrong, but numbers for March 22 has been restated. There have been some reclassification between banks and NHBs. Just looking at your Q4 presentation of FY22 and Q4 presentation of your FY23.
No. See, Abhijit, actually what has happened, from the year 21-22, as per SEBI LODR, we have to raise NCD to the 25% of the incremental borrowing.
Yes.
In future, you can find that NCD finding a place of 25% in the borrowing mix in the coming future, because in incremental borrowing, whatever we will come through the NCD. In that case, our bank borrowing may come down. That is one thing. That is what we envisage in the future. And our CPs have decreased because, as told, because we find that bank borrowings are cheaper than the CP borrowings. So if you find that the bank borrowing are costly and CP is at a low cost, our CP may increase. So that is the major change which has happened and likely to happen.
Understood, sir. So, sir, basically, the way we used to kind of classify, basically the way we used to report our borrowing mix has not really changed, right?
No. There is no change. There is no change.
Got it. Sir, secondly, you did touch upon the demand outlook and the fact that most other lending institutions have also acknowledged that there was some at least sentimental impact in demand on mortgages. Customers were delaying their purchases. But with some expectations of stability in interest rates, you are expecting this demand to recover in the second half of this fiscal year. Is that the right way to kind of look at it?
You are right. So if the rates remain steady or if they come down, then the demand, I think, should start coming, will be back in the market. Should see an improvement.
Got it. So, that's precisely why I asked. Basically, what I was trying to understand is during an interest rate upcycle, the fact that as a franchise we do annual reset on interest rates on a rolling basis. There was merit in, I would say, customers sticking around with us. But now that interest rates are stabilizing and then there are expectations that whenever in the next 6 months, 9 months, wherever interest rates start coming down, the fact that their interest rates will be reset on an annual basis, while banks will be very prompt in passing on any repo rate cuts, is there a risk that customers might want to move on or take balance transfers to other lending institutions? Or, I mean, given that you've seen such cycles, what is it that you would typically do in let's say, interest rate down cycle? How do you kind of retain those customers?
First of all, this kind of a 200 bits rate hike in a very short period is kind of unprecedented. Normally, any rate hike or reduction happens in a more gradual manner. And so therefore, this kind of a very high difference between the prevailing rates for new customers and existing customers is not usually there. So if the rates start going down in a gradual manner, the difference between the current and the existing rate for the customer and for the new customer would not affect much, and the reset will not be much of a problem. However, as regards what we normally do for such kind of things, we look at, we have an internal rating system, and we look at the customer, and based on the rating of the customer, which is on multiple parameters and gets reset every year, we will try to retain the customers who are really good, and we'll look at that. That is an option that we can always think of and look at to retain the best customer. But normally, as I said, it's normally not so much of an issue if it's a gradual kind of a reduction over a period of time.
Understood. So then just maybe adding on to that, hypothetically speaking, given that there has been a very sharp, I would say maybe 10, 11 months, very sharp increase of 20 to 50 basis points increase in repo rates. And for whatever reasons, again, hypothetically speaking, if there is let's say a 50 basis point kind of a rate cut anytime this fiscal year. So, I mean, what you are suggesting is while we will continue to have annual resets, just like we have contractually, but there is still that room to retain that customer who kind of comes to us and says that, listen, I'm getting 50 bips, 75 bips lower from another bank. So that flexibility still remains with us, is what I understand, right?
Flexibility is there, but as I also said, that a small difference in the rate does not would not be too very difficult to convince, because in terms of the customer, it's the EMI that matters. And the EMI generally doesn't change. It's the EMI remaining constant. The general impact is given in the balance tenure. So customers generally don't react so much to these kind of things. And floating rate interest rate or variable rate thing has been prevalent for more than close to 20 years now. So the customers are also aware of how it operates.
Okay. So it's the last question from my side. We have already kind of suggested that we have increased the provisioning cover on standard loans conservatively. So that point is well received, but two things that I wanted to understand here. Given that more often than not, when we don't take basically provisions during a particular quarter, we kind of defend it by saying that, listen, a lot of this moves in line with the LGDs, PDs, and what is the requirement of a ECL. And then obviously, there are quarters where we conservatively take provisions to shore up the provisioning coverage ratio. Basically, are we now kind of comfortable with these kind of provisioning cover, or do you think that there could be quarters going forward where we could see that conservatively we might choose to build on to that provisioning cover?
You mean to say, would there be a position of adding to this kind of cover, or you are saying would there be a withdrawal? Just seeking clarity.
Yes, sir. Just clarify. Fine. What I mean is, going forward, will there still be a case of, adding on to this provisioning to further increase the provisioning cover?
Yeah, we would definitely like to have a strong, it definitely adds to the quality, the strength of the balance sheet. So little provisioning would definitely be something we would look at opportune times.
Great, sir. I think this is very useful, and sir, congratulations on assuming the role of the CEO at Can Fin Homes and especially. Thank you so much.
Thank you so much.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your question to one per participant. If time permits, you may join the queue for any follow-up. Thank you. Our next question is from the line of Pawan Kumar from Ratnatraya Capital. Please go ahead.
Sir, can you give us the recovery numbers for this quarter and last quarter?
Pawan, can you
and secondly,
your voice is not very clear.
Sir, can you give us the recovery numbers for this quarter and last quarter? And secondly, in the stage 2 portion of restructured book, there was a portion where we were not being paid any EMIs. So what is the size of that portion right now?
Sorry? What is the?
What is the size of that portion right now?
So as I said earlier,
the restructured portion of the book. Yeah.
So the restructured book about 695 crores, in fact, has just started coming out of it effective mostly from February. So the major chunk of it is yet to come out of the restructuring. So it's too early a time to actually talk about or give you a picture on the performance of the restructured accounts. Probably, as I said earlier, the next quarter would be a time when we would be able to give you a clearer picture on how the accounts are moving.
Okay, but can you give us roughly what percentage of these accounts would be paying right now? Any EMIs?
So we have almost in terms of the collection, this thing about 78% of the customers have already paid and are regular. I mean, have started servicing the payment. Those who have come out of it, which is actually a very small number.
Okay. And what would be the recoveries number for this quarter and last quarter, sir, and for the year, if you could share?
You mean roll forward and roll back?
Yes.
Okay, so I'll just say it. Quarter-wise, we have the figures, but I'll just add up to give you for the year. Just a second, if you give us a minute, or probably we could share it with you. We have about 53 crore has been the roll forward, and about 48 crores is the roll back during the current year.
Okay, 48 crores roll back.
Just to clarify, we have recovered around 16 crores of NPA, and slippage was to the tune of 8.62 crores.
And this is for
Q4. That is in Q4.
This is in Q4. And 53 and 48 was for the entire year, was it?
I just total, I think you will have to give the total and give it to you.
Okay.
So in fact, our recoveries are more than the slippages.
Okay. And what would be your pool of recoveries, sir? Because I am assuming the recoveries being slippages is not in normal condition, right? Or is it?
Yeah, normal condition. And whatever NPA is there, we have identified around close to 70 crores of NPA, which we are targeting to recover, depending upon the availability of purchasers of the properties. So these we are targeting. Let us see what happens because I think these are the targeted numbers for this year. Okay.
And going forward, as an earlier participant also asked, is there going to be is the provisioning going to be bulky in Q4 as the case right now, or would it be spread evenly over from here on?
We would definitely be maintaining this kind of a PCR ratio, and let's see, we will whatever is required. If a good opportunity comes around, we would also like to add to this.
Okay, sir. Fine. Thank you.
Thank you. Before we take the next question, I'd like to remind the participants, so please limit your question to one per participant. The next question is from the line of Shripal Doshi from Equirus. Please go ahead.
Hello, sir. Good evening, and thank you for giving me the opportunity. So my question was more on a little bit more on the superannuation of our senior management team, because my understanding is that a large number of employees will be from the senior management will be retiring over the next 2-3 years. So, is that a fair understanding, and what is the?
Sorry, can you repeat? Your voice is breaking.
Yes. Shripal, your voice is breaking. Please use the handset or come in a network area.
Am I?
It is still breaking, sir.
Am I better now?
Yes, slightly better now.
So my question was with respect to the superannuation of our employees who've been part of the organization for quite some time. So what is the thought process to fill in that senior management positions over the next 2 years? And what? Yeah.
Yeah. So we have a very, stable team, not only at the top, but across the bands, various brands. So we have a lot of people even in the second level, and a good amount of succession planning that is happening, where we have enough people who can be groomed and can be brought up to the level as and when there are vacancies in the senior teams. So that is not an issue, because across the bands we have enough number of people who have been stable for a long time with the organization.
Okay, so we will be open to say hiring from the open market as well, or the thought process would be to groom and upscale.
If at all there is a opening and we require from outside, we will be open to it.
Got it, sir. Got it. Thank you so much, sir.
Thank you. The next question is from the line of Nilesh Jethani from BOI Mutual Fund. Please go ahead.
Thanks for the opportunity. Most of my questions have been answered. But
Nilesh, please use the handset. Your voice is feeble.
Am I audible now?
Yes, please go ahead.
Yeah. I had one question. Historically, pre-COVID, our spread when we compare to the banks, etc., was typically 1.5% with regards to the interest rates what we charge. And during COVID, we brought it down to 0.75, the spread between what we as Canfin charge and what banks typically charge. But now with most of the COVID, etc., behind us and state of economy largely coming back to normalcy, just wanted to understand what outlook do we carry with regards to charging clients on interest rates versus what banks are charging today. Thank you.
We will be operating in a very competitive scenario wherever it is possible, but at the same time maintaining a healthy spread and NIMs. So a 2.5% kind of a spread and a 3.5% kind of a NIM is something we will be looking at, and within that ambit we will be kind of pricing our loans. That's how it will operate.